We constantly guess what the future will look like, but we rarely ask how it will be funded. Let's run the numbers. Today we test one of the biggest economic proposals of the century: universal basic income. The idea is deceptively simple. Give every person a regular cash payment, unconditionally, regardless of employment status. The appeal is obvious in an age of accelerating automation. But the question that rarely gets asked is not whether we can afford it. It is what else we stop funding when we commit to it. That trade-off is the real stress test. Because when automation scales up, governments face a choice. Do you redistribute the gains broadly through cash transfers, or do you reinvest those gains into the systems that generate further productivity? This is not a moral question. It is an allocation question. And allocation questions have measurable constraints. Resources committed to one program are resources that become unavailable for another. So today we ask a precise question. If a society commits to UBI at scale, what does the opportunity cost structure look like, and which assumptions control whether it works? The first binding constraint is scope. UBI means universal. Every eligible adult receives the payment, whether they need it or not. That universality is also its most expensive feature. Economists studying anti-poverty programs have identified a core design tension. Broader universal programs that give to everyone necessarily provide less per person than targeted transfers concentrating resources on the poorest. That is an inherent opportunity cost built into the design. If your budget is fixed, spreading it universally means each recipient gets a smaller share than under a targeted program. This does not mean universality is wrong. It means universality has a price, and that price is denominated in the depth of support available to those who need it most. That trade-off becomes sharper when automation enters the picture. If automation displaces job categories faster than new roles emerge, the population needing support grows while the tax base funding it may narrow. So the problem is not just how much UBI costs. The problem is what the economy loses when those resources are not invested in retraining infrastructure, research, or productive capital formation. To understand this, we need to separate two concepts: the fiscal cost of UBI, meaning total expenditure, and the opportunity cost, the value of the next best alternative those resources could have funded. Fiscal cost is straightforward. Multiply the payment amount by the number of recipients. If a program pays $1,000 per month to 200 million adults, the arithmetic is large but simple. Opportunity cost is harder. It asks what else that same budget could accomplish. Could it fund public infrastructure that makes the economy more productive? Could it accelerate research that creates new industries? Interestingly, the opportunity cost framing changes the debate. Instead of asking, can we afford UBI, we ask, what is the highest value use of this budget, and does UBI beat the alternatives? And this is where automation becomes central. When machines perform routine tasks, the scarce resource shifts. It is no longer just labor. It is the capital and institutional capacity required to deploy automation effectively. If a government allocates a large share of national output to universal cash payments, that share cannot simultaneously fund public investment in infrastructure, education, or research that makes automation productive. This is the core of the opportunity cost argument. The bottleneck may not be money. It may be the institutional capacity diverted when a society commits to redistribution before building the systems that sustain it. So here is the assumption we need to state explicitly. This analysis assumes a budget-constrained government that cannot fund both full-scale UBI and full-scale productive investment. Change that assumption, and the trade-off changes. Now let us build the causal chain. Under a budget constraint, every dollar directed to UBI payments is a dollar not directed to public capital formation, including transportation networks, energy grids, and research institutions. These public investments have a compound characteristic. A bridge built today reduces transportation costs for decades. A research grant may yield patents that generate revenue for an entire generation of firms. UBI payments, by contrast, are consumed. They enter the economy as spending, which supports demand, but they do not directly create durable productive assets unless recipients choose to invest them. This creates an asymmetry. Foregone investment compounds over time, while consumed payments do not. The longer the program runs, the wider the gap between what was spent and what could have been built. Here is the constraint. If productivity gains from automation depend on continued public investment, then redirecting that investment to consumption transfers may slow the very engine that was supposed to fund UBIs. Now, a natural objection arises. Does UBI reduce the incentive to work? If people receive income without conditions, do they stop participating in the labor market? The evidence is more nuanced than the question suggests. Evidence from cash transfer programs in developing countries shows that concerns about recipients reducing labor supply are largely unsupported. Recipients often use the security to pursue better opportunities, education, or entrepreneurship. So the simple story that people stop working when given free money does not hold up well in these contexts. But these findings come primarily from developing country settings where baseline economic security is low. The transfer from developing country results to a wealthy automated economy is not straightforward. In a high-income economy, the marginal effect of an additional cash transfer on labor decisions could operate very differently. Now, one real-world test provides relevant data. Finland ran a basic income experiment from 2017 to 2018, paying 2,000 unemployed participants a monthly unconditional payment of €560. The results showed small employment effects. Recipients did not dramatically change their labor participation compared to the control group, but they reported better perceived economic security and mental well-being. This is informative but bounded. The experiment covered only unemployed recipients, not a universal population. A 2-year pilot in one Nordic economy cannot be generalized to all economies or demographic groups. What the Finnish experiment does contribute is a data point on well-being. When people have a guaranteed financial floor, their reported stress decreases. That is not trivial, even if employment effects were modest. So the labor incentive question does not have a single answer. It depends on the existing safety net, the payment level, the availability of meaningful work, and the broader economic conditions. And that brings us back to the opportunity cost. Even if labor incentives are manageable, resources committed to UBI still represent foregone investment. Does that foregone investment matter more than the security UBI provides? Now, here is a rational exception. The opportunity cost argument assumes foregone public investment would be well allocated. In practice, government capital spending is not always efficient. Funds may be wasted through poor planning. If the alternative to UBI is wasteful spending rather than efficient investment, the opportunity cost may be lower than it appears. The comparison holds only when the foregone use is genuinely productive. There is also a limitation in how far we can extend the evidence. The Finnish experiment and the developing country cash transfer studies operated under very different conditions than a fully automated future economy would present. We cannot assume that labor responses observed in a low-income rural context will translate to a high-income automated economy. The incentive structures, fallback options, and institutional environments are fundamentally different. However, there is a validating case. Even proponents of UBI acknowledge funding must come from somewhere. The debate within UBI advocacy revolves around which programs to cut or which new taxes to create. That internal debate is itself evidence that the opportunity cost is real. The question is never just whether UBI is desirable, but what must be sacrificed to implement it, and whether that sacrifice is acceptable. So the boundary is clear. UBI cannot be evaluated in isolation. It must be compared against alternative uses of the same resources, and those alternatives depend on institutional quality and economic conditions. So let us answer the opening question. Could UBI work? Under this analysis, it could, but only under specific conditions. The opportunity cost must be manageable, meaning the economy must sustain both redistribution and reinvestment. The labor incentive effects, based on what limited evidence exists, may be smaller than critics fear. But those findings are context-dependent and cannot be assumed to transfer across very different economic environments. The critical variable is productivity growth. If automation generates enough surplus to fund UBI without starving productive investment, the opportunity cost shrinks. If it does not, the trade-off becomes binding. And the design matters. A UBI set too high relative to productivity drains the investment pipeline. A UBI set too low fails to provide meaningful security. The calibration window may be narrower than advocates assume. This means UBI is not simply a policy you adopt or reject. It is a calibration problem. The right level depends on the surplus from automation, the efficiency of public alternatives, and institutional capacity. Follow the incentive structure. Under high automation and high productivity growth, UBI becomes feasible because the surplus absorbs the opportunity cost. Under low productivity growth, UBI competes directly with the investments needed to sustain it. The funding model decides what survives. UBI is not inherently good or bad, it is conditional. It works when the economy can afford the opportunity cost, and it fails when it cannot. And the assumptions that control the result are identifiable. Productivity growth rate, institutional efficiency, the marginal labor response, the depth versus breadth design choice. Change any one of these, and the equilibrium shifts. That is the honest answer to whether UBI could work. It depends on the scenario, and the scenario depends on which assumptions hold, which institutions function, and how much productive surplus the economy actually generates. So what can you take from this? When you encounter a UBI proposal, ask one question first. What is the opportunity cost? What specific investments would be reduced to fund it? If the answer is vague, the proposal is incomplete. A UBI plan without a clear opportunity cost accounting is an assertion, not a policy. The funding structure is the policy. Second, separate the labor incentive question from the funding question. A program can be affordable and still create perverse incentives or preserve work motivation while being fiscally unsustainable. Third, test the productivity assumption. If someone argues automation will fund UBI, ask how much surplus it would need to generate and whether that surplus is realistic given competing demands. Fourth, identify who bears the distributional risk. UBI spreads income broadly, but it may also spread risk broadly. If the program underperforms, the shortfall affects everyone rather than being concentrated. And fifth, resist the framing that UBI is either a total solution or a total threat. It is an allocation mechanism with specific trade-offs, measurable if you ask the right questions. This is not a prediction. It is a conditional scenario. UBI may be the right tool for specific conditions and the wrong tool for others. The discipline is knowing which conditions apply. Change the assumption, change the equilibrium. If you want to evaluate any UBI proposal seriously, start with the opportunity cost. Everything else follows from there. Next time someone tells you UBI is the answer, ask what it costs in terms of what we stop building. That is the real price. The future is just incentives at scale. See you tomorrow.